The US Treasury has just sold $25 billion of 30-year bonds at a yield of 5.216%. That's the highest rate the government's paid on 30-year debt since 2001.
That effectively means the interest rate which the US taxpayer pays to bondholders has soared massively in the last few years. The reason everyone should care is because government bond yields determine the value of equities, corporate debt, and even mortgages.
Let's be clear, America can still sell its debt. The vital question is, who's buying it, and what it now costs to keep them at the table. The US national debt passed $40 trillion this year.
That's an issue for Treasury Secretary Scott Bessent, because it means he needs to issue more and more bonds to refinance maturing debt.
Older bonds mature constantly. That puts the Treasury back in front of investors month after month, whatever the prevailing rate happens to be. For most of the last 2 decades, that dependence cost very little.
Interest rates in the US and globally were depressed. As inflation has surged back after the pandemic, we've seen government borrowing costs the world over rise.
Bond prices and yields move in opposite directions. As investors sold their bonds, the government's cost of borrowing climbed. More recently, that expense climbed furthest at the long end of the market, where lenders are committing cash for 30 years.
The reason that interest rate was so high is because borrowing over the long term carries extra risk for investors, and therefore they're demanding more and more compensation to adjust for those risks.
For decades, the Treasury market could rely on a fairly dependable group to buy these bonds: the Federal Reserve, foreign central banks, and long-term institutional investors, including pension funds. That base is changing.
As the amount of government debt has increased in recent years, they're becoming increasingly reliant on hedge funds, who are more likely to buy and sell over a shorter period of time.
A central bank can buy treasuries for reasons that have almost nothing to do with the return, and can keep buying even when the price moves against it. A hedge fund is much more price sensitive. It may often just leave. One group should, in theory, be filling that gap.
For decades, pensions would seek long-dated government bonds to match against their liabilities in the so-called defined benefit payment system. That means they promise pension members a certain payout when they retire. But in recent years, pensions have been moving towards a new system, which is instead based on market returns. Since governments can't rely on that same demand from pension funds, they have to seek investors at different maturities, such as money market funds, which will only lend their capital for up to a year.
So, at the very moment governments need investors willing to commit for decades, one of the few natural sources of that demand is becoming less dependable, and the long end of the market is left to buyers who are more price sensitive and more willing to walk away. This August, Treasury Secretary Scott Bessent changed tack.
Bessent is doing things which are unpredictable and changing the rules of the game.
He announced the government would increase buybacks of long-dated government bonds by financing shorter maturity debt, providing what the Treasury called greater liquidity support to the market. But it didn't immediately solve the problem.
A concern among bond investors is that if the Treasury becomes more unpredictable, they might start needing to demand a higher compensation for that uncertainty.
None of this would matter if it wasn't for this.
US government bonds are the center of the financial universe. They're used to price everything from the rates on corporate loans to equity valuations. Crucially, they're also a key determinant of mortgage costs.
The same repricing reaches landlords refinancing buildings, developers deciding whether a project still makes sense, and companies rolling over debt they took on when money was cheap. It reaches the government itself as well.
In August, US interest payments to bondholders hit a record $85 billion.
The United States now spends more servicing its debt than it spends on defense.
The main takeaway is interest rates will remain higher for longer for governments, consumers, and corporates around the world.